So you weren't gonna wear a costume for me either? Like, what the
I,
hell is with this play? No one wants to wear a costume for Halloween?
I know. My bad.
Thanks a lot. Screw it again. No one wants to celebrate Halloween, spooky season, or anything.
Yeah.
How's it going? Welcome to Consulting Logistics. My name's Kyle McNaught. I'm your host, and it's going to be a fun one today. We are getting a little spooky with my man, Chris Peckham, because we're going to talk one of the spookiest things, I think, for a modern day adult. Gas prices, fuel prices, and everything like that. The price of gas is on the rise, 50% in 2021. And it's normally right now in the fall season supposed to be more of a historical easing of pricing. So to talk about why we're seeing fuel prices rise, what to expect in the future, we had to bring on my man, Chris, who's constantly talking about this in the market report, which, as you know, you can always go download right now, FreightPlus.io. We have market reports every month. The one for October is coming out sometime soon. So that's another exciting thing. But in this podcast, we're going to discuss sort of how oil prices are created, sort of an oil price 101. Talk a little bit about what historically we see. And is that something we can truly even look to when it comes to oil prices? And then finally, what is in the future? What are we going to kind of think about? What should we kind of possibly see in 2022? Because I know at the beginning of 2021, Chris, we talked a lot about how the oil prices aren't going to get anything. But as we know, it's a crazy market. So Chris, how's it going?
Good. Doing all right. Just trying to ride out the, ride the wave here.
Yeah, the irony that we literally planned this out on Tuesday and then Massachusetts got hit with a massive windstorm that has knocked out power.
It's a nor'easter. We call them nor'easters up here.
Oh, yeah, I forgot. There's no snow, so I'm like, it's just a windstorm.
Right.
But it takes away now the demand for oil is once again up here. So I'm sure we're going to see some fun prices. Let's talk about it. I mean, right now the national average of diesel is up 50%. I mean, why?
Yeah. So a lot of it just comes down to basic supply and demand, right? So you're right. Since January 1st, it's actually up about 40% based on the recent release by the EIA, but it's actually up 56% if you look at when the price of on-highway diesel bottomed out, which was the week of 11/2. So 56%, that's well over $1 increase. And the thing is, the price of regular gasoline always follows or always trends the exact same as the price of on-highway diesel. So it's the same, right? And we see the sticker shock when you and I go to the pump to fill up our cars.
Mm-hmm.
You know, I'm spending significantly more than I did a year ago. And in fact, I was talking to a colleague out in the West Coast. There's a gas station in Gorda, California, which is like right in the middle of California on the coast, $7.58 for a gallon of regular unleaded.
Why is it? You got to talk to me, because I mean, my research, right? We were even looking at some stuff. I mean, the barrel of oil has risen $20 from August to October. The experts are predicting that it's going to continue to rise. What the heck is happening?
Yeah, a lot of it is just coming down to consumption, right? So the price of oil really bottomed out, and you and I were chatting about it, how it was actually trading negatively, right? You were actually going to be compensated to take physical possession of barrels of oil not too long ago.
Right.
But now as economies have continued to open up, there's just more consumption that's happening in the market. That's driving the price of crude oil up. So right now, between the WTI, which is the West Texas Intermediary, and the Brent, which is more of the global benchmark, they're both trading above $85 per barrel, which is nowhere near, some all-time highs that we saw back in 2008, or in the summer of 2008, where we had that crisis. Oil touched $145 per barrel.
So you talk about demand up and stuff, and I know it's something that we're going to kind of get into a little bit later. But I mean, right now, it isn't historically like the summertime is when demand's really up. I mean, people are back in school, summer vacations are over.
Summer driving season.
Yeah, summer driving season is kind of done. What is there something kind of right now that's kind of pointing to this? Is it the players that aren't just kind of cooperating with what the historic trends have been?
Yeah, I mean, I think when you look back and you don't see major COVID related disruptions like we've had to live through, it's tough to look at last year or 2019, 2018 and previous and try to say, okay, we're going to follow these same trends, right? All that stuff is kind of out the door. And we're establishing a new trend now. So you're right. I mean, coming out of the summer driving season, which is when you typically see the spike, should be a lull. But it is important to note that now we're moving into the winter months, right? So now people are going to need to heat their homes, and that's primarily a northern problem versus having more demand and more consumption in the south. But what we're seeing globally is, the big news is always around OPEC,
Mhm.
right? So OPEC is a bit of a cartel in that they are controlling. I don't mean that in a negative way. I mean, OPEC, I think, contains 15 different nations today. And if you include OPEC Plus, that would include Russia.
Mhm.
And they're really working together to sort of control the amount of production that's happening within those nations themselves.
Right. Now, we talk about it, so it's interesting. I mean, a lot of people, especially if we're making this more about how are oil prices, just how are they made. So is OPEC kind of that main contributor, the one who decides it? Like, how does OPEC kind of factor into pricing?
So it is like it
Okay.
definitely is because it's all over the news, right? So
Right.
it's
Right.
definitely influential. But if you look at the three main countries in terms of barrels of crude oil produced per day, you know, Saudi Arabia produces around 10 million barrels per day of crude oil. Russia around 10.5 million barrels per day. The US 10.5, 11 million barrels per day of crude oil production. So when you grab all of the countries involved with OPEC, yes, the total sum exceeds what we produce here in the United States. So they definitely have some influence. But as you and I have discussed, that influence to me, it's a little emotional, to put it mildly. So when OPEC says we're not going to increase production,
Right.
all of a sudden there's a reaction in the market, right? So everybody says, "Oh my God, they're not going to increase production. That means inventories could be low. That sends the price of crude going upwards." Now, it doesn't necessarily mean that we're running out of oil, right? It's just a very emotional response to market conditions,
Right.
similar to what we see in the stock market, right? You
Right.
and I were
Right.
chatting the other day. Wall Street may have a target of earnings per share of X, and a company may exceed their own earnings expectations, but not meet this expectation that was established on Wall Street. And all of a sudden, people are selling off the stock. And I sit there and say, this is a perfectly healthy company who just exceeded their own revenue targets, but it didn't meet an analyst target. So now there's something wrong. That to me is an emotional response, and it's all speculative.
So it truly is. We've talked about this of being speculative and emotional, but I mean, when we look at it, it's not like the supply is running out. They're just OPEC kind of. I mean, I know you have a quote that they just sort of they met and decided not to increase oil production.
Yeah.
In theory, trying to build up supply and therefore lower prices amid kind of the global.
Well, if you think about the goals of an OPEC nation, right? They want to make sure that they are generating revenue for their own companies. So Saudi Aramco, one of the biggest from a market cap standpoint, the biggest producer of crude oil on the planet, and it's not even remotely close. So the goal of an OPEC nation would be, all right, let's continue to drive revenues, right? So if you increase production, and it's a fine line, and I'm sure that there's a statistical analysis on where the slope of the curve means that you should increase production or decrease, but they want to keep production as high as they can with oil trading as high as they can because that's higher revenue. If they increase production and the price drops, that could be lower revenue coming into whoever that oil producer is. So there's a fine line that happens there, and you have to acknowledge that everybody's got some selfish interests in it.
Yeah, but I mean, speaking of you, like a self-interest, right? The U.S., like you said, we're one of the higher producing. What's happening with the U.S.-based producers? I mean, if it's OPEC, I get it, but especially kind of a lot of the online stuff is like, look at how bad gas prices are. Like, blame the U.S. president. I mean, what's happening with the U.S. producers?
Yeah, there hasn't been any significant legislation that I've seen, and I'm not a public policy expert, but I haven't seen any legislation that has a causal relationship to the price of gas or diesel or crude oil. Right. So we continue to produce. We obviously had some issues in the Gulf Coast with refineries being knocked offline, not all of which have been back on.
Right.
So there's obviously some production, hiccups that we got to get through there. But for all intents and purposes, the United States is a net exporter of petroleum products. And petroleum products, crude oil is a subset of petroleum products.
Okay.
Right. So you've got crude, you've got distillates, you've got motor gasoline. You have, what was the other one? Propane. So all that stuff is contained within petroleum products. So we are a net exporter of petroleum products. We are still a net importer of crude oil itself.
Okay.
And we actually import, from an import standpoint, we import the most petroleum products from our neighbors to the north, from Canada. And our biggest export trader of petroleum products, so what we send out, is actually Mexico, with Canada being a close second.
What about, I mean, I know a lot of like alternative energy is kind of a big thing, something that's going. How has that played a factor? Does that matter of like the initiatives to really try to get ourselves off of oil and fossil fuels, is that something that's causing the prices to go up?
Yeah, so the OPEC headquarters is actually in Austria, and they just recently released their 2045 projection around crude oil. And what they're saying is crude oil is here to stay and it's not going anywhere. However, to your point, and again, you got to remember who's writing the report.
Right.
Now, these are not. These are, very, very intelligent analysts, right? So they're trying to be objective, and the report itself is 340 pages long, which I'm not going to read, but there is a 30-page summary that you can download and read. But what they are saying, to your point around renewable energy is absolutely going to be the fastest growing in the energy sector, and that's going to eat into crude oil. But for the foreseeable future, crude oil is not going anywhere, and here's why. If you look at underdeveloped nations, right? So if you look at, folks that don't have access to an automobile today, once they do have access to an automobile, it's going to be an internal combustion engine that requires, gas, right? They're not going to be able to have access to an electric vehicle, right?
Reliable, power and
exactly.
stuff like yeah.
So now it's projected that 20% of the global fleet will be an electric vehicle by 2045, which is extraordinarily significant amount. But when you look at why oil is going to stick around, it's because of those underdeveloped nations finally becoming more developed, right? So they're just lagging behind, the faster growing nations, the more well-developed nations out there.
So really, if I'm hearing you correctly and trying to summarize sort of oil pricing 101, a lot of it is just emotional. Like things that we think of, things that you kind of read in the media of like, hey, it could be alternative energy, like producers saying like, well, it's not really worth going into fossil fuels. Things like the OPEC, just like the cartel running this oil. It's not really that. I mean, what we're learning is really there isn't a good, unfortunately, it's people that are running this stuff and people that are dictating the pricing.
Yeah, and it's all, I think, especially as Americans, it would be nice to be able to point to one boogeyman and say, this is the reason why.
Yeah,
right?
we need an enemy. Right.
It just makes it nice and easy for us. And then we can justify things in our brain when in fact, it's an amalgamation, for lack of a better word, of a whole bunch of different things. Right. So it's not any one specific thing that's driving prices up. Prices are always higher in the West here in the United States. And a lot of that is just because you have to get that fuel to the West Coast. They don't have pipelines that are running out there, right? So there are transportation costs related to all that. And of course, taxes. Taxes are a massive, massive piece of diesel and just regular gasoline. And that varies by state, So there's just all sorts of different stuff out there.
Well, that was extremely helpful. I know it's something you probably told me multiple times, and I just was too stupid to really understand what you're saying to me. Because I know we talk about this. We talk about the barrel price. We're always talking about this in the market reports, and it's something that's important to pay attention to. And I guess that's what my next question is how does fuel, like especially the price of fuel, how does it play a factor into a transportation program? Like what do companies think about when it comes to fuel, or especially the sophisticated transportation programs? How do they view fuel prices?
Well, let's start on the other end of the spectrum with the companies that, are just accepting tariffs from carriers and really don't have an understanding of how fuel factors into things. So I've seen and we've seen some of our existing customer base before they became customers saying, oh, we have great pricing in place. And we'd look at the tariffs and say, yeah, this pricing looks competitive, but your fuel schedule is terrible because you're defaulting to the carrier's fuel schedule. So as they became customers and they're working on more of a neutral fuel schedule, which is tied to the national average, you essentially are able to hedge against wild fuel swings. So fuel's super high right now. Like in the truckload space, I think based on our fuel schedule, it's about 42 cents per mile. But if you were just to go out and you didn't have really the knowledge, understanding, or the wherewithal to understand pricing and how that works, especially as it relates to fuel, you may accept a carrier's tariff and say, oh, wow, this looks great, not paying any attention to the fuel schedule. And instead of paying that 42 cents per mile in the truckload space, it could be 55, 60 cents. You just don't know.
So you really don't pay it based off of like, hey, this is what the cost per gallon is at the pump. You're paying it off of like, hey, you need to travel this far. We're going to say that's going to cost like oil is going to be 40 cents or 42 cents per the mile that we're driving?
Well, it's tied to the national average of on-highway diesel. So
Okay.
last week, the EIA released that it was $3.71. So there's a corresponding table that anytime the national average falls between this range, it will correspond to a cost per mile in the truckload space.
Okay.
In the less than truckload space, it's a little bit different. Same methodology, national average ties to a table, but then it's a percentage of the line haul. So what ends up happening is if, say, I'm a shipper in California and I want to use a California-based carrier, then that California-based less than truckload carrier is probably going to defer to the average of on-highway diesel in California, which is
Right.
by far and away the highest in the nation. So right there, you're paying, that average is over $5 per gallon today, with a national average is $3.71. So if you're not thinking about it, that percentage of fuel that you're paying on every shipment is going to be significantly higher than if you were in a neutral or a fuel schedule tied to the national average. I know that's an awful lot, but at the end of the day, you want to work with a managed transportation provider who's able to identify these things, negotiate these things, and manage these things on your behalf.
And this is all just negotiated rates. Like this is when you're doing carrier sourcing and you're trying to actually get contracts in place and stuff. When you're doing spot, is it just you're at the whim of an emotional market when it comes to fuel, or how's that work?
Yeah, spot and contract works different. If you're in a negotiated pricing, you're going to have a set fuel schedule, right? Good, better, and different. You'll have a set fuel schedule that everybody has access to. If you're in the spot market, typically it's an all-in price, right? So I need to move a truckload from Columbus, Ohio to Dallas, Texas. If there isn't negotiated pricing, you go out and you ask for pricing, and somebody's going to give you a rate. And the rate is going to include fuel. And it's typically not broken out. That's just an industry-related thing. But, if you think it through, you get negotiated pricing. You absolutely want to have everybody on a fuel schedule. And if I'm a carrier, I want to be in a fuel schedule too.
Right.
Because if I'm saying, I'm just going to give you an all-in rate and then fuel fluctuates significantly, all the carrier is going to come back and just say, hey, fuel's way up. I need to change my pricing. Whereas if they were on a fuel schedule, the portion of fuel would just float with the market, right? As fuel goes down, fuel is a smaller component of the overall price. As fuel goes up, it's a larger component of the overall price. So,
Jeez, and with the pricing being so kind of emotional and speculative, it's got to be difficult as a kind of an operations folk to just, how do you even pay attention to it? How do you kind of keep everything going?
Yeah, it's tough. And a lot of our customers, they're asking the question because now they're getting more savvy. They have a lot more information. We've just constantly bombarded them with information about what's happening in the marketplace. So the question is, what happens next? What do I expect in 2022? And that's the tough one to answer. right? We've talked about it a million times in every market report. If there's no disruptions, yada yada yada. Honestly, oil, the price of oil and the corresponding price of diesel and regular gasoline is not going to hang around this $3.71. It's going to come down. It is. I'm drawing a line in the sand.
All right. I'm
not saying it's next
don't
week.
watch our January episodes from 2021.
I'm not saying it's going to be next week. In fact, we'll probably see another bump next week as the EIA releases the next results. But in the interim, in the short term, it's going to come down.
Now, that's just because demand's going down and the emotional, like, hey, I freaked out because I heard OPEC's not going to increase the supply, and like, all right, maybe I was a little crazy. That's why like the prices will go down, or why exactly can we confidently say like it's going to go down?
Yeah, well, and I know I said we can't look at historical trends just because last year was just such an anomaly.
Yeah.
But I think we have to treat last year as exactly that, and just an anomaly. And at some point, supply and demand comes back into balance. And even we may see the price of crude go up. It may hit $100 per barrel. That's not out of the realm of possibility. But what we see right now with the price of crude is this phenomena called backwardation. So what backwardation is that anytime, and it's not just applicable to crude oil, but anytime that an underlying asset, the value of it today, is more than a future-based value of that commodity, what you're seeing people short sell. They're selling it off today, hedging that price. And what that's saying is that the futures-based price is actually too high, right? So by doing this, it starts to get the market a little bit back in balance. So I still think that everything is going to come down. It may not start until the new year, but I think we'll see a regression to the mean, so to speak.
I love that. So really, it's a lot of kind of algorithms back then stuff. There's nothing like there's no action or something that you can kind of realistically like. Hey, I'm just going to pay attention to the news, see if like President Biden does something. There really isn't something that's going to kind of like, oh, cool, they get to flip the switch and it's going down.
I mean, I think the things that I track is, as we know, there are a million different things that go into the price of crude. And it's not just tied to production. There's a lot of speculation, a lot of emotion. But I consistently track the price of crude because whatever that does, that's a leading indicator. That just means that that translates directly to on-highway diesel and what you and I are going to pay at the pump. I think it's important to see how the administration addresses OPEC. They've already been more vocal about putting more pressure on OPEC. OPEC did agree to increase production by 400,000 barrels per day. I think that was back in September. Each month, they're going to continue to increase that until they hit pre-COVID levels, which should definitely help, right? And by help, it's not like we have a shortage of crude oil in the globe right now.
Yeah, I mean, it's something, especially the loyal listeners to Consulting Logistics have heard. I mean, like you said, it's not like it's a light switch. Like it's flipping off a refinery. It's turning off these production lines and putting them back on. It takes time. It takes also there's a worker shortage, which this industry is absolutely not impervious to dealing with this type of stuff. So I mean, you've talked about it. It takes time, but we live in such a give me to me right now demand. Like, how dare you charge me $3 a gallon? That I could see why it's one of those hard to like really comprehend or understand. I mean, you got my eyes sideways when you're talking about the whole future back assets, all that fun stuff.
No, I mean, we call it a 101, but there's nothing 101 about these markets and how they really operate. I mean, and I am the furthest thing from an expert on it. But these are really interesting times. And I know everybody hates the word interesting when there's more money coming out of your wallet. Right. Present company included. But it's something that we watch very closely. And if there are questions, if folks need help, then certainly reach out to us.
So to summarize, if we really want to understand the impact of what rising fuel costs have on kind of a transportation program, if you're in a really well sophisticated, negotiated kind of contract, you should have a fuel schedule it works. It's neutral. It's not something that's going to favor the carriers. And that's sort of what we really advise upon. Like the reason why you want to do negotiated contracts, the reason why a carrier sourcing strategy is so valuable is because of things like this, these external emotional increases and things that are hard to kind of be able to be a part of.
Tying to the national average is typically going to be competitive than just a regional based tariff. Now, there are regions, like if you look at the Gulf Coast region, that average of the on-highway diesel is lower than the national average. But on the whole, it's good to be tied to a national average, especially if you're somebody that's shipping all over the U.S.
Right.
Just makes sense.
All right, Chris. Well, I really appreciate your time today. I know you didn't want to dress up for Halloween. Maybe next year, I can finally convince you to do something. Maybe throw on the pterodactyl balance, and then I'll throw on Nell's princess thing. So we'll have a fun one.
Awesome.
In the meantime, thanks for watching Consulting Logistics. And that's our show. Do you have anything that you're interested in and what type of factor it plays into a logistics program? Let me know in the comments section. In the meantime, like and subscribe to our channel. I'm Kyle McNaught. Thanks for watching Consulting Logistics. Rock and roll and have a fun, spooky day.